this video, I'm going to explain an index fund, a mutual fund, and an ETF in a way that even a cat can understand. First, what's an index? Think of it like a scoreboard for the market. It's just a list saying, here are the stocks we're watching, and here's how much each one counts. You don't buy the list, you use it to check the score. So what does an index actually track? In finance speak, we call them assets, but really, that just means stuff you can own that's worth something and can be traded. The big ones are stocks, shares of companies, and bonds, which are basically loans to governments or businesses. Some indexes even track things like gold, oil, currencies, or real estate trusts. Why bother with an index at all? The market's massive. Thousands of companies, tons of bonds, all kinds of other things, all moving at once. An index gives you the big picture in a single glance. Up today? Down today? You'll know right away. What kinds of indexes are out there? There are a few. The first is broad, like the S&P 500. That's a big mix of large U.S. companies. The second is sector-based, like the NASDAQ 100 for tech. The third is size-based, like the Russell 2000 index for small-cap U.S. companies. And the fourth is international, like FTSE All-World ex-US index, which covers stocks in developed and emerging markets, excluding U.S. So you might ask, Ken, who actually makes these lists? Not the government. Companies do. S&P, Dow Jones, MSCI, FTSE Russell. They set clear rules like, first, only big U.S. companies, or second, just tech, or third, only bonds. If something breaks a rule or shrinks too much, it can get kicked out. If another grows, it can join in. Oh, and here's a biggie. Don't forget this. You can't buy an index. It's only the scoreboard. Say you wanted to own all 500 stocks in the S&P 500 yourself. You'd need a giant pile of cash and, a ton of time to place hundreds of trades. An index fund does it in one step. You put your money in, and boom, you instantly own a slice of everything on that list. Take the S&P 500 index. It's talking about 500 big U.S. companies. Apple, Microsoft, Amazon, Google, Nvidia, and 495 others. The index is just the benchmark, basically a piece of paper with 500 names on it. An S&P 500 index fund, or, in this example, SPDR S&P 500 ETF, is the product you can buy that invests in that list. We call that copy the index, or tracking the index. There are two main kinds of index funds. The first is an index exchange-traded fund. The second is an index mutual fund. I'll cover their differences later. Real-world examples? There's the Vanguard S&P 500 ETF, ticker VOO, which tracks the S&P 500 index. The Invesco NASDAQ 100 ETF, ticker QQQM, follows the NASDAQ 100 index. On the mutual fund side, you've got the Vanguard 500 Index Fund, symbol VFIAX, basically the mutual fund version of the S&P 500 index. And the Schwab Total Stock Market Index Fund, ticker SWTSX, tracks the Dow Jones U.S. Total Stock Market Index. This index represents nearly the entire U.S. equity market, including large cap, mid cap, and small cap stocks. All right, so we've talked about funds that just copy the market index. But what if you want somebody actually trying to beat it? That's where active funds come in, and they can show up as either exchange-traded funds or mutual funds. Instead of just mirroring a list, these funds hire managers who hand-pick what to buy and sell. They might grab a stock today, sell it next week, add a brand new one, or drop something that isn't working. They're aiming to do better than the index. Like, if the S&P 500 makes 10%, they're shooting for 12. To get there, they use all kinds of tools, digging into research, running models, spotting trends. They're constantly studying companies, prices, news, figuring out what stays and what goes. You've probably seen active ETFs like ARKK. It goes after new, innovative companies. JP Morgan Equity Premium Income ETF focuses on income with a smoother ride. PIMCO Active Bond ETF sticks to, bonds, steady stuff. On the active mutual fund side, there's T. Rowe Price Blue Chip Growth Fund that seeks long-term capital growth using blue chip companies. Each has its own goal, but they all share one thing. Someone's at the wheel, using research and strategy, trying to steer past the market instead of just floating with it. Oh, and here's a quick tip. Active funds usually cost more because they need big teams doing all that research and trading. Index funds, on the other hand, are passively managed, so you'll often hear people call them passive funds or passive index funds. Same thing. And since they don't need as much hands-on work, their fees are lower. Honestly, it took me a while to realize those terms were just different ways of saying the same thing. So if we just lump them together into two groups, index ETFs and active ETFs under ETF, and index mutual funds and active mutual funds under mutual fund, what's the real difference between the two? ETFs are sold on stock exchanges, places like the New York Stock Exchange, NASDAQ, London, Tokyo, and Hong Kong. But you need a middle step, a broker or an investing app. Think Interactive Brokers, Fidelity, Schwab, TD Ameritrade, Robinhood, Webull. That's your doorway. Personally, I use Interactive Brokers because of the low fees, easy setup, and solid support. If you're curious, there's a link in the description. Mutual funds work a little differently. With lots of them, you can go straight to the source, Vanguard, BlackRock, Fidelity, Schwab, and buy in directly through their website or app. Another thing, ETFs trade all day while the exchange is open, just like stocks. You get the live price the moment you hit buy. Mutual funds settle once a day after the market closes. That price is called the NAV, Net Asset Value. Here's the timing part. If you place a mutual fund order at 11 a.m., you don't get an 11 a.m. price. You'll get the next NAV, calculated after the market shuts down. ETFs have a NAV too, but because they trade on exchanges, their market price can drift a little above or below that NAV during the day. NAV's not scary. It's just the fair value per share at the end of the day. With mutual funds, think, I buy now, I get tonight's NAV. With ETFs, think, I buy at the live price. Fees are another difference. Mutual funds might charge a buy and sell fee, sometimes called a spread. Plus, they take a yearly expense ratio, which you'll see on their site. ETFs have that yearly expense ratio too, but instead of a buy-sell fee, you usually pay your broker's trading fee. Some apps don't charge for trades, others might add account maintenance fees. And here's a fun twist that trips people up. Take Vanguard. They're a fund manager. They build and run funds. They've got a mutual fund called VFIAX that invests in the S&P 500 index. And they've also got an ETF called VOO that does the exact same thing but trades on an exchange. Same ingredients, just two wrappers. Fidelity's a little different. They're best known as a broker, an app or platform where you can jump on and buy a Vanguard ETF or single stocks. But they're also a fund company with their own products like the Fidelity 500 Index Fund. And here's an even wilder one, BlackRock. Like Fidelity, they run a bunch of funds, but they're also a publicly traded company. You can literally buy stock in the business that runs funds which invest in tons of other companies. Now, here is one more chance to take a look at this flowchart before I move to the next thing. Now, have you ever stuck on words like PE ratio, short squeeze, or even just, what the heck is a stock? I put together a video where I explain every stock market term. Simple, clear, zero jargon. Click it now and finally see how all the pieces fit together.